Hello students, welcome to second part of valuation of goodwill. Yesterday we went through calculation of goodwill by means of simple average profit method. Now today we will be discussing about calculation of goodwill by weighted average profit method and super profit method. Coming towards question number 6, please just go through the question. From the following information, find out weighted average profit only. We are not just required to calculate goodwill, we are just required to calculate weighted average profit. Now year wise information is given, year 13-14, 14-15, 15-16 and 16-17 and their respective profit 60,000, 70,000, 90,000 and 1,10,000. For this we are required to calculate just weighted average profit. Now for calculation of weighted average profit, formula for calculation of weighted average profit is total weighted profit divided by total of weights. Now how to calculate same? So say for 4 years the information was provided, year and their respective profits. Now we need to apply weights. So whenever not clarified in the question, we apply weights in order of years only. That is, first year will be allotted weight of 1, second year 2, third year 3 and fourth year 4. Now we need to multiply profits and weights, that will give weighted profit. This is like calculation of weighted mean. 60,000 into 1, that will give 60,000. 70,000 into 2, that will give 1,40,000. 90,000 into 3, that will give 2,70,000 and 1,10,000 into 4, that will give 4,40,000. Now we need to sum it. Sum total comes to 9,10,000. Same way, applying the same in the previous formula, total weighted profit is equal to 9,10,000 divided by total weights. So total of weights, that is equal to 1 plus 2 plus 3 plus 4, that is equal to 10, dividing it by 10, and the resulting answer will be equal to 91,000. So that's the value of weighted average profit. Now same way, question number 7, but in previous question we are just required to calculate weighted average profit. In this case we are required to calculate goodwill as well. From the following information of Babulal and Kantilal's firm, determine the value of goodwill on the basis of 3 years purchases of last 5 years weighted average profit. Now profit for last 5 years are provided. We need to apply weights and calculate weighted average profit, and thereafter we need to multiply it with years of purchases. So it's similar procedure. Like in this case again, goodwill is equal to weighted average profit into years of purchases, and years of purchases is given in question was 3 times. But for this we need weighted average profit. So for weighted average profit, formula will be total weighted profit divided by total of weights. Now for calculation of total weighted profit, information about 5 years were provided. Year wise 2012-13, 13-14, 14-15, 15-16 and 16-17, and their respective profits were 40,000, 60,000, 70,000, 90,000 and 1,20,000. So applying weights 1, 2, 3, 4 and 5. Now multiplying both, 40,000 into 1, that will give 40,000. 60,000 into 2, that would give 1,20,000. 70,000 into 3, that will give 2,10,000. 90,000 into 4, that will give 3,60,000, and 1,20,000 into 5, that will give 6,00,000. Total comes to 13,30,000. And sum total of weights, 1 plus 2 plus 3 plus 4 plus 5, that gives 15. So applying the same in our formula, 13,30,000 total weighted profit divided by total of weights 15. So 13,30,000 divided by 15, and if we simplify it, the resulting answer comes to 89,666.67. We can round it off first or we can round it off later on as well. Now the same amount, weighted average profit, will be applied in formula for valuation of goodwill. So 89,666.67 into years of purchases. So that will give 9, 27, 2 lakh 69,000. That would be the amount of goodwill of entire firm. So this would be the way of calculation of goodwill. So that was about calculation of goodwill by weighted average profit method. Now we will be learning about calculation of goodwill by super profit method. Before we start, just go through question. Pushpa, Pratibha and Bhavna are partners in partnership firm. They decided to change their profit and loss sharing ratio from 3:1 to 1:1:1. Yesterday we discussed in theory, we calculate goodwill whenever we carry out reconstitution, and change in profit sharing ratio is kind of reconstitution. So again we will be required to calculate goodwill. Therefore they decided to make valuation of goodwill. It is clarified. However, in this case we are not concerned with these all things. We are just concerned with valuation. On the basis of partnership firm's profit and other information, determine the value of goodwill on the basis of 3 years purchases of super profit. Goodwill was to be calculated at 3 years purchases of super profit, and furthermore assets were 6 lakh and liabilities were 2 lakh 50. Expected rate of return is given 10%. 3 years profits are provided. First year 14-15 was 80,000, 15-16 was 70,000 and 16-17 was 90,000. So these were the informations provided. On this basis now we are required to calculate goodwill by super profit method. So steps to keep in mind. The very first step is calculation of capital employed. Why we need capital employed? Because we want to ascertain expected profit. Why we calculate expected profit? Because we need to ascertain super profit. And why we calculate super profit? For valuation of goodwill, because goodwill is equal to super profit into years of purchase. So super profit, how to calculate super profit? It is equal to average minus expected profit. Average profit can be calculated by simple average or weighted average profit method, that depends upon the method. And expected profit is based on capital employed. So capital employed into expected rate of return has to be applied. Now for same, capital employed is required. So how to calculate capital employed? So it is equal to assets minus liability or capital plus reserves minus losses. Now in this case we are provided with value of assets and liabilities. Assets were 6 lakh and liabilities were 2 lakh 50,000. So 6 lakh minus 2 lakh 50,000. So resulting balance comes to 3 lakh 50,000. That's the value of capital employed. Then second point, calculation of average profit. The average profit may be by simple average or weighted average profit method. According to this question, the profits were not in increasing or decreasing trend. Like first 80,000, then it was reducing, then again it was increasing. So whenever there is lack in trend or it is not specified in question clearly, we apply simple average profit method. So in this case 80,000 plus, for sum of profit, 80,000 plus 70,000 plus 90,000. So total will be equal to 2,40,000 divided by number of years, that is 3 years profit. So 2,40,000 divided by 3. So average will be equal to 80,000. Then calculation of expected profit. The expected profit is based on capital employed and expected rate of return, which will be given in question. So capital employed as available or ascertained rupees 3,50,000 into expected rate of return is given in question. It was 10%. So 3,50,000 into 10%, resulting answer would be 35,000. Finally applying the same in super profit. The super profit is equal to average profit, that is 80,000 minus expected profit 35. What this implies is, suppose we invest this 3,50,000 in our business, we will be able to earn 80,000. Same 350 if invested outside, we will be able to generate 35,000. Means we are able to earn more than outside. So it is preferable to invest money in our business. When the value of average profit is less than expected profit, there will be no goodwill of this kind of firm, because it is preferable to invest money outside rather than investing in our business. This is the terminology applied here. So same way in this case, average profit was 80,000 and expected profit is only 35,000. So excess of average over expected is 45,000. That will be termed as super profit. And finally applying the same for calculation of goodwill. So super profit multiplied by years of purchases. Super profit we have seen in previous case, it was 45,000 multiplied by years of purchases as given in question, which was 3 years. So goodwill of entire firm would be equal to 1,35,000. Similarly, for question number 9, we are again required to calculate goodwill. Capital of Meena and Manju's firm is 4 lakh. Expected rate of return is 10%. Last 3 years profits are 1 lakh 20, 1 lakh 10 and 1 lakh respectively. Compute the value of goodwill 2 times of super profit on the basis of weighted average profit method. It is clearly mentioned that goodwill has to be calculated on the basis of weighted average profit, and it is equal to 2 times of super profit. So again same procedure has to be applied. First step would be ascertaining amount of capital employed. So there are two possible formulas. First formula is assets minus liability. Second formula for same is capital plus reserves minus losses. In this case we are not provided assets and liabilities, so implied we have to apply second equation, that is capital plus reserves minus losses. Capital of both the partners are provided. It is in total equal to 4 lakh. There is no mention about reserves, neither there is mention about accumulated losses. So ultimately the total capital employed of this firm will be equal to same 4 lakh. Then calculation of average profit. Now for calculation of average profit, there are two methods, simple average or weighted average profit. However, in this case it was clarified that we are required to calculate weighted average profit. So for weighted average profit, again the procedure to be followed, year wise profits are available, we need to apply weights. Again, when not clarified, weights are to be provided according to the order of year. First year 1, second year 2 and third year 3. Now multiply profit and weights, that will give weighted average profit 1 lakh 20 into 1, 1 lakh 20,000, 1 lakh 10 into 2, 2 lakh 20,000 and 1 lakh into 3, 3 lakh. Then adding up all these, 6 lakh 40,000 weighted, sum of weighted profit and sum of weights is 6. Applying the same in previous equation, 6 lakh 40,000 divided by 6 years. So on simplification, resulting answer would be 1,06,666.67. You can round it off to nearest rupee immediately or later on. I am keeping it this way only. Then coming towards next part, calculation of expected profit. So expected profit is equal to capital employed into expected rate of return. Capital employed was available, it was 4 lakh. Expected rate of return as given in question, it was 10%. So 10% of 4 lakh will give us 40,000. Again our business is able to generate more profit compared to outsiders business, outside market. So it is preferable to invest money in this kind of business, and this kind of firm will be having goodwill. Average profit, now super profit is equal to average minus expected profit. So average profit was 1,06,667 minus expected profit was 40,000. If we simplify it, resulting answer comes to 66,666.67. And finally applying the same for calculation of goodwill. So goodwill is equal to super profit 66,666.67 multiplied by years of purchases. So in this case it was 2 times of super profit, so multiplying it with 2. So resulting answer now comes to 1,33,333.34. Finally you can round it off to nearest rupee, that will be equal to 1,33,333. As it is less than 50 paise, we'll keep the previous one. That's all about calculation of goodwill by weighted average profit method and super profit method. Now tomorrow we will be again looking into calculation of goodwill by capitalization of profit method. Thank you. Have a good day.